So, you got that rejection email from a VC. Ugh, we've all been there, but in this explainer, we're going to look at some thinking that completely flips the script on that no. We're going to make the case that it might just be the best thing that ever happened to your company.
I know, right? That's a pretty bold statement. It goes against everything we're taught about fundraising. Chase the yes, pop the champagne for the term sheet. But what if that rejection isn't really a failure? What if it's more like a filter, protecting you from a partnership that was just never going to be the right fit in the first place?
To really get why a no can be a good thing, we have to pull back the curtain on the whole VC industry. We're going to do that by busting 3 of the biggest myths that founders tend to believe. And we'll use some hard data to show you what's really going on. Okay, let's start with the biggest myth of them all. It's this idea that VCs have some kind of Midas touch, that every fund they raise just turns into a gusher of money. It's so easy for us founders to feel like we're pitching to these infallible financial wizards. But the data, it tells a very different story. So what's this number all about? Well, there was this landmark 20-year study by the Kauffman Foundation, and it found that 50% of all VC funds failed to even return the money their investors gave them. And get this, that's after their fees. A whole lot of the rest barely even beat the public markets. So yeah, the idea of guaranteed success, it's just a myth.
So why? Why do half of these funds fail? The answer is right here. Venture capital returns follow a brutal power law. A tiny fraction of deals, we're talking just 6%, are responsible for the vast majority of all the profits. This structure forces VCs to say no to almost everything, even to really good, solid businesses, because they are hunting for that 1 in a million grand slam. Your business might be a fantastic double or triple, but if they don't see it as a company that can return their entire fund, they have to pass.
Okay, so if VCs aren't necessarily these financial geniuses, then their value must come from their deep operational expertise, right? I mean, they've been there, they've done that. Well, that brings us to myth number 2. This assumption that every VC is a former founder who has walked a mile in your shoes. The reality is pretty startling. According to data from the National Bureau of Economic Research, a staggering 93% of professional VCs have never actually founded a venture-backed company themselves. Just think about that. They haven't been the ones staring at the ceiling at 3 a.m. worrying about how to make payroll. They haven't had to hire a team from scratch or build the very thing they're now asking you to build. Their expertise is often in finance, which is great, but it's not the same as founding. All right, this last myth. This one might be the most practical and important one for any founder who's out there fundraising right now. You see VC in someone's LinkedIn title and you just assume they've got a checkbook ready to go. But the truth is, that's often not the case at all. So here's what's really happening behind the scenes. Most of the new money, the new capital, is flowing to the same top 20 or 30 big established firms. At the same time, the smaller, newer funds are having a really tough time raising money themselves. So that person you're pitching might be out of what they call dry powder, which just means their fund is already fully invested. Or they could be in the middle of trying to raise their own fund and don't actually have the money to give you yet. After we bust these myths, the whole power dynamic starts to feel a little different, doesn't it? It's not just about you auditioning for them. It's just as much about figuring out if they are even a real viable partner for you. So the big question is, how do you actually do that? The answer is, you change the game. You stop being the only one in the hot seat. You need to flip the script and start qualifying them, just like they're qualifying you. And this isn't about being cocky or arrogant. It's about being smart and protecting your single most valuable asset, your time. So what does that actually sound like? It means you have to ask some direct questions. First up, ask about their current fund. What's its vintage, its size, and how much is left to invest? This tells you if they actually have money to deploy right now. Next, ask about their typical check size to make sure you're not wasting your time. And this one's crucial. Find out if you're actually talking to the decision maker. This can save you from months of meetings. And finally, ask for a clear timeline to a term sheet. This is how you separate the serious folks from the time wasters. And here is the golden rule you have to live by. If you ask those direct questions and you get back vague, evasive, squishy answers, that is your signal. It's your sign to politely and professionally move on. Your time is way too precious to waste on conversations that were never going to lead to a check anyway. So let's just end with a simple reality check to really lock in this new mindset. Let's strip this whole relationship down to its core.
You, the founder, you're the one who innovates. You are the one building the actual asset, the thing that creates value. The VC, they're a middleman. They manage capital that comes from their investors, the LPs, and they allocate it to assets like your company.
And that's really the ultimate takeaway here. You can absolutely build a successful, profitable, world-changing company without ever taking a dime of venture capital. But a VC cannot build a fund without founders. They literally cannot exist without you. So the next time you get a rejection, just remember who holds the real power. Remember that you are the creator. And then get back to building.